Stock markets may be at record highs, but there's still plenty to concern investors. There's politics, of course. The UK, riven by Brexit divisions, will have a general election this side of Christmas. The central banks are also mucking in. Later today, the US Federal Reserve wraps up its two-day meeting and may well cut rates by another quarter basis point. Can policy do enough to keep markets rising? At what point should investors focus on company fundamentals? And will politicians mess it all up? Uncertain times call for cool heads.
We will be leaving the EU.
America is winning again.
Do not waste this time.
Hello and welcome to Cool Heads. In a minute, I'll be talking to two portfolio managers, Charlotte Harrington from Multi-Asset and Sajiv Vaid from Fixed Income. But first, here's our rates trader, Sam Knight. Sam, hello to you. You've been looking at some US data. What's it telling?
So I've got here the US Manufacturing Index. They speak to over 300 purchasing managers of large companies. Above 50 shows expansion, while below 50 is contraction. So it peaked last November and has been falling ever since and now sits in contraction. So if I overlay the US 10-year Treasury yield, you can see it's been a pretty good leading indicator. It's fallen since last November and yields have just started to back up over the last month or so.
OK, well tell me about that. What's that showing you? Because that does seem to be an important inflection point.
It is, yeah. And really the main driver of that is the US-China trade tariff. So they pushed back the October 15 tariff extensions and they've sort of moved towards a phase one agreement. And really it's all about confidence of the consumer to spend that money and confidence of the businesses to invest. So we might see that start to back up now.
Well, thanks very much, Sam. Well, let me come to you two. Charlotte, first of all. That inflection point, it looks to be pretty positive, and yet we're expecting the Fed to cut today. Why is that?
Well, that's right. So markets are absolutely priced for a cut today from the Fed, and they've really guided quite heavily towards that. The Fed have been looking at a raft of things, but they've pointed to the external environment and some weakness in the domestic economy, particularly around some of the interest rate sensitive sectors. But the question really for us going forward is how much more do they need to do and how much more are they willing to do in light of the fact that they've already eased quite a bit this year?
So that's very much an easing picture in the US. But Sajiv, you look at a UK fund. The Bank of England is also meeting. Would they follow suit? They've managed to resist for over 3 years now.
I think, as you said, they have been the notable exception this year in terms of a major central bank not cutting. And I don't expect them to move in November. However, from my perspective, I think this is a mistake. I understand the predicament they are in with regards to Brexit uncertainty. But I think they should take the lead from other central banks about an insurance cut because the domestic economy is weak and the external environment, as shown by Sam's and what Charlotte said, is weak. And I think they will come to that conclusion in the next few months.
So if the Bank of England might be cutting, of course, across the channel, the European Central Bank is already in negative territory and continuing that pattern. Is there an argument, going back to the States, for the Fed to make further insurance cuts?
Well, I mean, the Fed have really described all their policy easing this year as insurance cuts. So I think the hurdle for them to moving meaningfully lower requires the data to really force their hand. And I think probably that's the message they're going to be trying to give markets today, which is, we've made our insurance rate cuts. There have been some slight positive developments on the trade fronts, as we've already referenced, and from here on in, we want to see what the data does.
It all sounds a little bit desperate, doesn't it? We've got rates cutting in negative territory, more QE. Are we running out of ideas, Sajiv?
I think there is a question mark about the efficacy of monetary policy and its impact on the economy when interest rates are so low. And I think this is why the debate's moved on a little bit, talking about fiscal policy. And I think that will be the next step for politicians to embark on. And I think more crucially for the UK, that could be the guinea pig for that sort of policy of loose monetary policy and loose fiscal policy.
And there might be the opportunity, given that we've got a general election on the 12th of December here, so whatever shape that government takes, I imagine there'll be quite a bit of pressure on them to loosen the purse strings.
Yeah, but I think in the UK, we have definitely moved on from the era of fiscal austerity to now, I think, a fiscal largesse that we haven't seen for the last 20 years. So I think these have severe implications for the UK and general markets, and if successful, it could be sort of replicated on a global basis.
But going back, to the monetary policy toolkit, if you like, the sort of European and Japan economies now in negative rates, and that's seems to have been part of their toolkit. I don't think that's necessarily part of the Federal Reserve's toolkit, and so these conversations around what can central banks do in the next crisis, given rates are already relatively low, sort of continues, I think, across the board.
Yeah, and I think one of the lessons we've probably learned over the last 10 years is the limit of zero bound rates needs to be challenged. Obviously, we've seen what's happening in Europe, but let's not think that can't happen in the US or even the UK.
And bear in mind that a lot of these central banks are doing policy framework reviews at the moment. So this is absolutely live. And at the margin, I'd say there's a shift towards looking more towards the yield curve and managing the yield curve as opposed to front-end rates.
So how should investors position for this? Because it sounds like it's a very interesting time at the moment. What are you thinking?
Well, I think whatever the environment, that search for yield will continue. However, I think one of the things where we are in the cycle, both economically and credit cycle, it requires a better quality of yield. And I think that's the shift that we'll see over the next few years.
Quality. And Charlotte, how about you?
So I think when we look globally, we sort of look at yields and think they've really fallen a very long way. And if we're right to think that there's a bit of a stabilisation in the data, that the central banks are becoming more reluctant to cut rates for all the reasons that we've discussed, then actually being a bit cautious on what historically have been safe assets and being short government bonds would make sense.
Okay. Sensible advice. Many thanks to today's cool heads, Sam Knight, Charlotte Harrington and Sajiv Vaid. In our next show, we'll be delving into the key investment risks and opportunities behind the headlines. Until then, thank you very much for watching and goodbye.